Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to talk about how the bank is shutting down my credit line. And I always like to show off this $280,000 home equity line of credit. And just found out that by next Friday, I'm not going to have it anymore. And I know some of you have been warning me, right? Some of you are warning me, like, this whole depending on lines of credit thing, it could, they could shut it down. And you're right. You're right. You're right. I'm not going to have access to this $280,000 line of credit anymore because I'm gonna have access to this $373,500 line of credit. So, for all the people saying, "Hey, they could shut down your line of credit," that's right because this other credit union is offering me a bigger one. So I said, "Yeah, you can shut it down. Let's shut it down." All right. So let's go ahead and get started. Velocity banking. What is it? It's a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And yeah, I'm not gonna have access to my $280,000 line of credit anymore. I mean, it's true. It's clickbait, but true because the bank will shut down my line of credit. I think by next Friday, and then I'll get a instead of a 280, I'll have a 373,000. Maybe I'll still feel like this guy. I don't know. All right, so let's go ahead and talk about velocity banking. First step is a budget. So, a budget is your debt attack plan, income, expenses, leftover savings. Look at this negative $2.77, and we have $167,000 in credit card debt, one modest car loan, and one modest mortgage. Not that bad, right? 225,000, 3% non-debt operating expenses, 2,500. And what we're gonna do is we're gonna have the same income and then have the same expenses. And what's really important in our expense breakdown, we list every single debt that we have because this is debt payoff strategy. Now, here's the first thing you want to do when you do velocity banking. So you see this negative $2.70 number. What you do is you just put at a big fat zero. Okay. So how does this look like in real life? Well, I show you my checking account. Money comes in and then it just goes right out into that line of credit, and this goes to zero for most of the statement balance. But it's just like the people have such a hard time with this because they feel like I gotta save money. Now, obviously, it would be better to have $0 in savings than negative $2.77 for most people. They'll prefer a positive number than 0. So even if it's like $2.77 or $3 positive savings, they prefer that 0. But when we do velocity banking, there's a reason why the 0 is highlighted, right? I'm not gonna save money. And then what we're gonna do is we're gonna turn our negative $2.77 um, cash flow into something positive with the help of something called a line of credit. So, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So, by next Friday, I'm not going to have access to this line of credit, $280,000. But when I have access to it, I can potentially just click a button and get up to $280,000 in one swoop, right? Click a button and they'll put it in my checking account, $280,000 line of credit. Okay. $280,000 line of credit. And then soon I will have access to $373,500 in lines of credit. And the secret to getting credit is that banks don't lend money to people who need it. So if you're a person who needs money, you're not going to get a line of credit, especially if you're negative $2.77 short. But I always like to demonstrate, what if you had a free and clear line of credit? It's almost like having a seatbelt when you crash a car. It's like you crash the car here. And the problem is a lot of people, they want to learn how to drive after they crash the car. You don't want to do that. Okay. You want to learn how to drive before you start to drive the car. Okay. So, but let's just do this. We're going to assume we have access to $170,000, 8% line of credit. And what I'm going to do is I'm going to move all of this credit card debt. And I think it's $167,000. Let me quickly check. 5, 8, 15, 27, 37, 10, 35, 35, 12, 18. And then I'm going to sum it up. And that's $167,000, right? And then let's just do, let's say, a balance transfer. This is pretty much what a balance transfer is, and move it to that 8% line of credit. Well, guess what? Even though our income is the same and we're negative $2.77 here, let's just do 0, 0, 0, 0, 0, 0, 0, 0, 0. So all three, or not three, 10 credit cards, and they're magically moved to the line of credit, even though it's the same income. You literally went from negative $2.77 to $5,343.06 of cash flow. See how easy that was? And then the final step is you're going to put the entire 9,000 into the line of credit, take the expenses out, and then after every single month, the balance is going to go down about 5,000 has been changed, right? And so what we're going to do is we're going to go ahead and calculate it, right? Calculate the next month's balance, I2 plus 1. And then this one is G2 plus H2 minus 5343.06. Whoopsie, where did I get the false from? G2 plus H2. And then what we're going to do is take the average daily balance, right? We do that. And then we multiply by the interest rate, 0.08, and then divide by 12. And then what we do is we copy and paste, and look at that. See how we're struggling when we're doing banking the traditional way, where we pay for things at a checking account and leave our, in this case, negative savings left over. Whereas if we don't save money and we consolidate our cash flow, right, then we literally went from negative 277 to $5,343.06. And yeah, gosh, this is so easy. All right, so now let's go ahead and do this. And what we're going to do is we see that in about 3 years, 36 months, all that credit card debt was paid off. So let's go ahead and do this 36 months. And then this is going to be 167K. And now I'm going to do copy and paste right here. And then now what we're going to do is we just got 2 more loans. This should be easy, right? So, whoopsie, I screwed up. Which loan is this? 25.5. I'm going to hide these or delete these. And then, yeah, let's do this. So this is a loan calculator that I have to kind of, oh, did I screw up? 5.5. Let me see, 382.02. So 382.02. Ooh, it's a negative $16. Okay. But the outcome, okay, so let me actually update this. It's 5329.37. And let's see how long it takes. Is it still 36 months? It is. Okay. It is. It's 36 months. Okay. But I want to be a little bit more accurate. All right. So 36 months, we paid it off, right? And then now let's go ahead and do this in 36 months. What's the balance of these loans? And so now the balance of the car loan is about 8,000. So let's move that into the line of credit. So I'm going to just do this right here, move this car loan into that line of credit. And then this is going to be plus 8663.51. And then what's our cash flow now? Well, it's you get an extra $382. And then our cash flow is 711 and some change. So I think this is negative. Oh wait, this is not negative yet. All right. So I added the car loan here, and then now it's 5711.39. Yeah, did I screw up? Why is it 5711.39? Okay. Why does it seem like the cash flow is actually lower? Did I screw up? 5343 57 57 711.39. Oh no, okay, I did it right. All right, so now let's go ahead and do this, and we see that in 37 months, the debt is paid off of the car, so 37 months. And then that's going to be 187K, and now time to tackle on that mortgage. And this will be so easy and quick. All I gotta do is type 37, and then I get the latest value of the mortgage, 30%, not 30%, 3%. So let's go ahead and fill that in. So did I get this right here? 210 051.94, 051.94. And then what's our income? What's our expenses? So let's just do the income expenses part first. And then I'm going to do this here 9160. And then our expenses is everything except for the loan we're trying to pay off. So it's 2,500 here, 2,500 here. And then let's just do a $10,000 chunk, move that loan into the line. Ooh, 2.8 years. 2.8 years. All right. So one thing I just want to quickly mention is that if you move the whole loan into the line, you pay pretty much double, right? Whereas if you do small chunks, you don't. Okay. Warning. Okay. Don't move the whole 30-year mortgage into a line that's at a much higher interest rate, right? So 2.8 years reminds me of my own situation of having paid off my mortgage in 2 years and 9 months. Oh, that's right. I paid off my mortgage in 2 years and 9 months. Okay. All right. Anyways, this is now 0, and then this is going to be 37 divided by 12 plus 2.9. This is going to be 5.98 years debt free. Okay. Now here's the thing. And I pretty much say this in every single video where it's like, you know how like on YouTube you listen to Velocity Banking, they're like, pay off your mortgage in 7 to 10 years. I'm like, what are you talking about? For why not pay it off in 2.8 and be debt free in less than 6? Mortgage plus all your other debt, including credit cards and student loans and all that junk, right? And so now we're debt free in under 6 years, and now we have plenty of time. And you know what you can do when you have plenty of time? Make a ton of Excel spreadsheet videos on YouTube so you can get that sweet, sweet $200 a month in additional revenue and cash flow. Okay. All right. All right. Well, that's it for today, folks. Korean Lanta Mentorship. And yes, the bank is going to shut down my home equity line of credit. They will. So I can get another $373,500 home equity line of credit. And what's the secret to getting all these lines of credit is that banks don't lend money to people who need it. All right. Well, it's Korean Lanta Mentorship, and I'll see you on the next video.